We determine debt-to-income ratio by assessing our borrower's gross monthly income. So what's the difference between gross monthly income versus net income? The buyer's gross monthly income is the income prior to taxes being taken out. That is the income that we are able to use when qualifying your borrowers for a mortgage. Whether the borrower is a W-2 versus a self-employed borrower determines what documentation we request. Now, if you've got a W-2 borrower, it's pretty easy to calculate that income, but when you've got a self-employed borrower, we highly recommend that you get your loan officer involved. Front-end ratio, or front-end DTI, is the monthly housing expense divided by the borrower's gross monthly income. That front-end ratio is what we also refer to as the housing ratio. It is the percentage of the borrower's income that is being used for their monthly mortgage payment. Back-end ratio is the total monthly debt, which includes all consumer debt. So the borrower's housing payment, credit cards, auto loans, student loans, all of those debts combined divided by the gross monthly income provides us with the back-end ratio. Typical maximums for qualifying are 28 to 31% for the front-end ratio or the housing ratio, and 36 to 45 for the back-end ratio or the total consumer debt. Now, let's talk about how to determine what a buyer can afford. In order to pre-qualify a buyer, we're going to assess the monthly income. You're going to take that gross monthly income, then we're going to estimate their total debts. Now, total debts is going to include credit cards, auto loans, student loans, any debt that is going to report on your consumer credit report. This does not include things like utilities, car insurance, cell phone bills, things of that nature. So the total monthly debt, and then we're going to apply the debt to income ratios to that. You're going to multiply your gross monthly income by the maximum debt to income ratio percentage in order to determine the maximum allowable debt. This gives you your back-end ratio. Subtract the existing debts to determine the maximum mortgage payment. So once you subtract out those consumer debts from the maximum, this is going to provide you with the front-end ratio or their maximum house payment. Now consider down payment and closing costs, because your max ratios and monthly payment are going to be based on the loan amount and what the borrower is actually financing, not the purchase price. And when you have a borrower that you're out shopping with, and maybe you know that their monthly payment is going to be $1,500 a month, but they want to know if they offered $10,000 more or $5,000 more, how much more that payment would be. A general rule of thumb in order to make this determination is to take your interest rate, times it by 10. So if your interest rate is 7%, times that by 10, that gives you $70. 7 times 10 is $70. And then that $70 is what the monthly payment is, more or less $10,000. So $10,000 plus would be $70 more, $10,000 minus would be $70 less. So we're going to go through an actual scenario based on our borrower pre-qualification. So in this case, we're going to assume our borrower's gross monthly income before taxes is $6,000 per month. To estimate the total debt payments, we're going to say that this customer has $550 a month on a car payment and $225 a month on credit cards and a $75 per month student loan payment for a total of $850 a month in debt. To apply our debt to income ratios, we're going to take that total gross monthly income of $6,000 and times it by our max debt to income ratio, which we're going to assume in this case is 45%. And this is going to calculate our maximum allowable debt for this customer. And that is equal to $2,700. From that $2,700, we're going to subtract our debts of $850. In addition, we are also going to subtract out what we're going to estimate for property taxes and homeowners insurance, because that can also affect our borrower's affordability. In this case, we're going to assume $200 a month for property taxes and $100 per month for homeowners insurance, so an additional $300 in expenses. When we subtract that $850 and then the $300 for taxes and insurance from our $2,700, that leaves us with $1,550 that can be used towards your buyer's mortgage payment. So our maximum mortgage payment is $1,550. So let's go back to our general rule of interest rate times 10 gives you your general monthly payment per 10,000 borrowed. So in our previous scenario, we said our interest rate was 7% times 10, that gives us $70 per 10,000 financed. Now, in order to figure out what the maximum amount of a loan is that this borrower can afford, we would take our maximum mortgage payment of $1,500, divide it by $70 per month for the $70 per monthly payment per 10,000, and this gives you the number of 10,000s that can be borrowed, which is 21, and gives us 210,000. 21 times 10,000, 210,000. This is a quick, easy way just to do the math and determine the borrower's total allowable items that can impact debt to income ratio. We just want to reiterate that. So they include property taxes, homeowners insurance, and homeowners association dues if required, and they are included in the monthly housing expense. These amounts can be varied, so it is so important to have a good line of communication with your lender when making an offer on a property to ensure that if the property taxes are higher on a home or there's homeowners association dues, that it's not going to have a negative impact on your borrower's debt to income qualification. Sometimes a loan is at risk of being denied, and here's how you can help as an agent. Communicate with your lender. Ask what the issue is, and if there's an alternative loan option. Explore buyer solutions. Can they pay off debt to improve their debt to income ratio? Can they increase their down payment and lower the loan to value? Would a co-borrower or a gift of funds help? Consider different loan products. FHA or VA may have more flexible guidelines for your borrower. And some lenders offer portfolio or non-qualifying mortgage products that might work for unique income situations. Adjust the contract if needed. Request a seller's concession for the closing costs. Extend the closing timeline for additional qualification steps. Refer to credit or financial counseling. Sometimes buyers just need to put a better plan in place and start over and reapply at a later time. And then lastly, when all else fails, refer to credit or financial counseling. Some buyers just need a short-term financial plan before reapplying. And lastly, consult a different lender that you know and trust. Not all lenders have the same qualifying criteria. Before we wrap up, here are some additional tools that you can use to help your buyers. As we had mentioned earlier, Mortgage News Daily, mortgage calculator apps are great tools that can help your buyers start to work on determining their financial situation well in advance. Mortgage News Daily, free application. I suggest that you all download it. It's going to provide you with the average mortgage interest rates on a daily basis and provide you with some useful calculators. And then Dinkytown Financial Calculators is a great wealth of knowledge resources that you have available that you can use in order to determine multitudes of different situations for your customers. Lastly, reach out to your mortgage partner for detailed client scenarios. Having a trusted lending partner is the most important tool in your tool belt when it comes to financing. And leaning on these resources will make things easier for you and make you a more effective agent. Thank you.